Why, yes, I do have a bobblehead of myself. Don't you?
When you need some dough, you don't know where to go in this patriarchal capitalist hellscape. Well, here's the sitch, we're gonna help you, sis, because bitches get riches. Bitches get riches. Bitches get riches. Bitches get riches. And so can you.
FDIC insured banking doesn't mean what you think it means. The truth about securing your savings. Okay, so today we're going to talk about a government agency you've probably never thought about much before, the Federal Deposit Insurance Corporation. But first, a little family history about my grandparents. And they went through it. My grandmother endured a childhood in fascist Italy during World War II. At the age of 12, she passed by Nazi soldiers on her bike while she was carrying supplies for the Italian resistance in her bike basket. And she nearly starved on a diet of nothing but carrots and yogurt and eggs from the chickens they raised at home. And she even saw her neighbors murdered in the street. When she grew up, though, she met an American soldier on leave in Rome, and that happened to be my grandfather. He was a light-skinned, mixed-race man who grew up poor in the Deep South. And when he was 18, his teeth were kicked out in a fight after his black school's football team beat the white school. So pretty harrowing stuff. After the army, he actually chose to pass as white for the rest of his life. So you can see why these two were exceedingly cautious about most things. Their lived experiences didn't exactly breed trust in the wider world. Even so, in the 1960s, they were convinced to invest in the stock market without fully understanding what that meant. So the first time the stock market hit a major downturn, they watched their investments plummet. And they panicked, and they pulled all of their money, what was left of it anyway, out of the stock market and vowed never to invest in the stock market again. Instead, they then put all of their money into an FDIC insured bank account. And when the account reached the maximum insured amount, they opened another bank account at another bank. And then another, and so on, gradually opening bank accounts and maxing out the insured amount rather than investing. So by the time my papi died at age 94, they had saved over $1 million. But it was all scattered across multiple banks. It was a massive headache for my dad and his siblings to run around not only finding, but consolidating and organizing these bank accounts to secure elder care for my grandmother. So, this little family fable I'm telling you because it holds an important lesson about money management. Today, we're going to discuss what my darling grandparents got wrong about the FDIC, what they could have done differently, and why I don't blame them at all for the choices they made. Andiamo! So what the hell is the FDIC? The Federal Deposit Insurance Corporation, FDIC, is an independent agency created by Congress to maintain stability and public confidence in the nation's financial system. To accomplish this mission, the FDIC insures deposits, examines and supervises financial institutions for safety, soundness, and consumer protection, makes large and complex financial institutions resolvable, and manages receiverships. In other words, the FDIC insures money you've deposited in a bank. So if anything happens, and I'm talking fraud, theft, bank collapse, just for example, you'll get your money back safe and sound. And that all sounds pretty neat. The FDIC dates back to a pretty grim time in American history, the Great Depression. The government created it through the Glass-Steagall Banking Act of 1933 as a way to get people to trust banks again. And at the time, the maximum FDIC insured amount was $2,500, which is literally 1/100th of the $250,000 that the FDIC has insured since the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. They've actually raised the amount several times over the last century because inflation, it's a wonder. If you've ever seen or heard a bank advertisement, and you have eyeballs and ear holes, so yeah, you've probably encountered the term FDIC insured. But you've also never received a bill for insurance through the FDIC. This is because banks pay the FDIC to insure your money, making the FDIC kind of like Geico for banks. But as with most insurance companies, there are limitations on which bank accounts are insured, what exactly gets insured, and how the insurance company handles claims. And it's there that my beloved old people, and most other Americans, get the FDIC wrong. Before we go any further, you should actually make sure you understand a few core concepts like how bank accounts, inflation, and the stock market work. Fortunately for you, in our infinite benevolence, we have already covered these topics at length, which you can read in the articles that we'll include in the show notes for the audio version of this, and that you see right here on your screen. Which banks are insured by the FDIC? If you learn nothing else from this article, let it be this. Not every financial institution is insured by the FDIC. This is for reasons both legitimate and underhanded. You can easily determine if the FDIC insures a particular bank account with their handy-dandy Bank Finder tool, which you can find at fdic.gov, at the link on your screen or the link in the show notes. All right, when shopping around for a bank and account type that suits your personal needs, you should include FDIC insurance on the top of your list of must-haves. Because not only is FDIC insurance a safe and useful thing to have, it's also required of every U.S. bank, whether it's chartered by a state or the federal government. It's not simply an indication of a smart, appropriately risk-averse, and reputable bank. It's a litmus test for law-abiding, above-board banking activities. So if you're considering a savings or checking account at a bank and it does not have FDIC insurance,
you in danger, girl.
FDIC insurance is not just a basic precautionary measure, it's the law. Even banks that have gotten up to some questionably shady shit over the years, and I am looking at you, Wells Fargo, they understand that FDIC insurance is both the minimum assurance they can offer to their customers, as well as the minimum requirement they must meet to even accept your deposits. Which probably means that if they could get away with it, a lot of banks would just not pay for insurance. What's that? Oh, no, I don't struggle with trust issues due to generational trauma. Why do you ask? So why wouldn't a bank be FDIC insured? There are 4 main reasons why a financial institution might not have FDIC insurance. 1. The credit union exception. Credit unions. We love them. They align perfectly with our pro-labor, pro-consumer protection, pro-regulating capitalism stance here at Bitches Get Riches. But while having almost everything in common with banks, they are not. Which means credit unions do not have FDIC insurance. And that's okay, because they're instead insured by something called the National Credit Union Administration, or NCUA. And that's a governmental organization that serves the same function as the FDIC, just for credit unions. In fact, the credit union to NCUA relationship is actually so similar to the bank to FDIC relationship that I'm not even going to break it down here. Suffice it to say that if you're considering a credit union over a bank, make sure it has NCUA insurance, just like you would be making sure the bank has FDIC insurance. 2. The private insurance exception. But what if your bank or credit union has neither form of government-banked deposit insurance? Believe it or not, some states and territories allow credit unions to forego government-run insurance through the NCUA and instead pay for private deposit insurance. And I say, believe it or not, because this is, on its face, the sort of self-evidently bad idea that causes libertarians to fall headfirst into the no true Scotsman fallacy. Look it up. It explains a lot. Private insurance companies fail all the time. We know this. For example, a 1991 bank run in Rhode Island caused a credit union's private insurance company to totally collapse. People lost money they thought was insured, and the state government had to step in and clean up the mess for everybody. Meanwhile, since its inception, the FDIC has made sure that no depositor has lost a penny of insured funds as a result of failure. I'll be sticking to the FDIC and the NCUA. Thank you very much. Reason number 3, the foreign bank exception. Foreign banks are not subject to U.S. laws about FDIC insurance. That's pretty self-evident. But they are subject to the financial laws of their home countries, most of which have their own equivalent of the FDIC. Le Juste Ingrès Fond du Banque being the French equivalent, I presume. 4. The not actually a bank exception. Credit unions aren't eligible for FDIC insurance because they're technically not banks. It follows, therefore, that if a financial institution is not a bank, it has no legal requirement to get FDIC insurance. This makes total sense with bank-adjacent companies like, say, an insurance broker or an investment firm. Sure, they handle large chunks of change, but they're not actually holding that cash as deposits. So the Federal Deposit Insurance Corporation doesn't have jurisdiction. But what about fintech? Here lies the most obvious way of getting around the FDIC. Fintech companies and third-party apps that work with banks and accept deposits, but aren't technically banks themselves, are not required to have FDIC insurance. Two of the biggest culprits currently are Chime and Stash. But remember Synapse Financial Technologies, that technically not a bank that melted down in the spring of 2024 and took gajillions of uninsured savings with it? Yeah, especially in the aftermath of the Synapse bankruptcy, fintechs are very careful to reassure customers that their money is, in fact, FDIC insured through their partner banks. But I'd be real careful to check the fine print on that agreement before assuming my deposits are safe. Oh, and if it's not clear by now, if an actual bank or credit union doesn't have any form of deposit insurance, they're breaking the law and you should give them a wide berth. What kinds of accounts are FDIC insured? The FDIC insures deposits, not investments or other kinds of assets. Here is a handy guide to what they do and do not cover. FDIC insured accounts include checking accounts, saving accounts, certificate of deposits, money market deposit accounts, cashier's checks, and money orders. What's not FDIC insured includes mutual funds, annuities, stock investments, bond investments, life insurance policies, cryptocurrency, the contents of safe deposit boxes, U.S. Treasury bills, bonds, and notes, and, of course, Scrooge McDuckian money vaults. Some of these are surprising, and some not so much. Treasury bonds and T-bills, for example, aren't covered by the FDIC insurance because they're backed by the full faith and credit of the U.S. government. That's like having a different insurance policy for your dental care as opposed to your vision care. And do I have time to talk about how weird it is that eyes and teeth aren't considered part of your body when you're buying health insurance? No. But does it enrage and confound me? Yes, it does! More concerning is the fact that what you put in your safe deposit box at a bank isn't insured. My research wasn't totally reassuring on this one. Supposedly it's because federal law doesn't consider safe deposit boxes to be deposit accounts, and therefore their contents aren't eligible for FDIC insurance, but that sounds like a weird technicality, so do with that what you will. Investment accounts aren't FDIC insured for exactly the reasons my beloved grandparents discovered, because markets are constantly fluctuating. The value of your stocks, your bonds, your other investments, it's all completely dependent on market conditions over time. No one, not even your wise yet humble bitches, can guarantee your rate of return on the stock market. You cannot, nor should you want to, insure a constantly moving target. Oh, and I really hope I don't need to explain why cryptocurrency isn't FDIC insured. How much does the FDIC really insure? If you're using my grandparents' playbook, you're probably thinking, okay, I'll just put no more than $250,000 in a single bank account before opening another one to stay fully insured. And this is obviously assuming you manage to save that much money all at once without investing, which, for the sake of my point here, let's pretend it's a rational probability. But let's take another look at the FDIC's fine print. FDIC deposit insurance covers $250,000 per depositor per FDIC-insured bank for each account ownership category. The key phrases here are per depositor and each account ownership category. So, to return to my familial example, my Nona and Poppy each counted as a depositor on their joint savings account. So as of 2010, the FDIC would have insured that account not for $250,000, but for twice that, or $500,000. Now, let's say that in addition to their savings account, they had a trust for their kids at the same bank. That's a different account category. That trust could have been insured for up to $1,250,000 per owner. At 2 owners, that's $2,500,000. Divided among 6 kids, that's $416,666 per kid. I'm not great at math, but I think that's a whole lot more money insured than $250,000. I thought about creating another handy-dandy table here to illustrate exactly how much money it's possible for one family to insure through the FDIC at a single bank. But I didn't want to overwhelm you guys with my incredible technical skills. And, plus, the FDIC actually has something called their Electronic Deposit Insurance Estimator, or EDIE, and that just does the job for me. There, you can put in the name and location of an individual bank, your account type, as well as the bank balance to make sure your money is fully FDIC insured. It's very reassuring, and you can find all of that at FDIC.gov. You should never need maximum FDIC insurance. I've made a big deal so far about how much money the FDIC will insure for you. But here's the thing. You should almost never need maximum FDIC insurance. If you have at least $250,000 you can afford to keep in cash in a deposit account for an extended period, then holy shit, my dude, you should be doing something else with that money. Letting it waste away in a checking account or a savings account, not accruing interest, well, that's literally letting it waste away. We've been over this. Money that does not earn interest is money that loses value due to inflation. It's called depreciation. At the very least, you should put that money into a CD, which is notably FDIC insured. And there, it'll still earn a small but secure amount of interest. But it would be far better off invested in the stock market. I cannot stress this enough. The stock market, a small business, real estate, any of these investments would be better for your money in the long term than safely and like a frightened animal sticking it in an FDIC insured bank account. It's great to have the peace of mind that comes with FDIC insurance. My grandparents certainly thought so. But as they say, no risk, no reward. And who's they? Nobody knows, but I'm sure they're very wise. So make sure your money isn't just sitting around getting smaller when it could be working hard to make you more money. What else does the FDIC do? The FDIC doesn't just insure your money. It also conducts oversight to ensure that banks aren't up to shady shit, examines banks for compliance with a whole host of consumer protection laws like the Fair Credit Billing Act, the Fair Credit Reporting Act, the Truth in Lending Act, etc., etc. It monitors smaller banks to warn them if they're taking on too much risk, effectively catching problems before they have the chance to escalate. It leaps into action when a bank fails, resolving the situation and making the depositors whole. And it's led by a board of directors, including the director of the Consumer Financial Protection Bureau. Wait, the CFPB? The government agency whose sole purpose is to protect us from fraud, corporate overreach, and predatory business practices, that CFPB, the one whose staff DOJ tried to cut by 90%, this one? That's right, the FDIC is under threat too.
Knuckles for 8.
I am once again asking you to be worried about a societal institution going away because of the Trump administration. I don't want to keep doing this, you guys. Do you think I like Cassandraing all over the public library and USAID and Medicaid and the CFPB and the fucking FDIC? No, I do not. And I'm not doing this for my health either. Nevertheless, here I am, once again, lighting the beacons for a governmental institution so GD boring, I had to trick you all into watching this with a salacious headline. The truth is that while we were all nervously watching DOJ gut the CFPB, its closely linked sister agency, the FDIC, was already quietly drowning. Even before Trump took office and gave his chainsaw-wielding pet tech bro carte blanche to hamstring our administrative state, the FDIC was understaffed. Losing over 500 employees during the DOJ frenzy absolutely did not help. And look, I'm not saying the FDIC is a perfect paragon of governmental efficiency. By all accounts, the agency had problems even before Donnie T took office. But the Trump administration's plans for the FDIC seem to revolve around not strengthening and improving the organization, but weakening financial regulations in general, and the CFPB and FDIC in particular. The entire point of the FDIC is to insure your money. Without the FDIC, how exactly will we know our deposits are safe? And if we can't even trust that our savings are secure, my script actually says to trail off into ominous silence. So let me try that again. And if we can't even trust that our savings are secure, the most infuriating part about the DOJ cuts is that fucking with the FDIC neither makes our government more efficient nor saves it money. The FDIC is funded entirely by banks, not even the tax dollars of individual citizens. Man, if only I'd recorded this video sooner. Perhaps my persuasive style of internet sleuthing and clever wordplay could have convinced our tyrannical overlords to change their policies towards consumer protections. In the meantime, you should call your fucking representatives. Again. And tell them you'd prefer the government keep insuring your money through the FDIC. The hidden truth behind the FDIC. I started all this with a headline that told y'all that there was some dark secret hiding in the bowels of the FDIC. And you probably thought I meant that in a bad way. Nope. I just wanted to get your attention, which is spectacularly difficult when the topic at hand is finance plus insurance, a dull combination with the power to shrivel the mental boner of even the most pedantic of nerds. As you can see, the truth behind the FDIC is that it's actually more generous and accommodating than most of us previously understood. It does more for the average bank customer than just insure up to $250,000 at literally zero cost to any of us. For once, some good news!
Hi, remember me?
FDIC insurance at work. Just to drive the point home, let's review an example. The Silicon Valley bank crash of 2023. A bunch of VC tech bro types worked themselves into a self-inflicted bank implosion that would have been disastrous for the bank's customers if it hadn't been for their FDIC insurance. Paying those insurance premiums meant that while the bank was forced to dissolve, its customers didn't have to pay the price of the banker's incompetence. Instead, the FDIC swooped in, majestic cape a-flappin', and rescued every beleaguered savings and checking account at SVB with the kind of banal competence we take for granted in a functioning governmental agency. But the FDIC didn't stop there. Part of the problem behind the crash was that Silicon Valley Bank's customer base was made up largely of, well, Silicon Valley tech startups and entrepreneurs with assets well over the FDIC insured limits held at SVB. But because of an emergency ruling by the FDIC known as Systemic Risk Exception, the FDIC was able to make all of SVB's customers whole. The FDIC saved SVB's asses and assets by taking over the bank and transferring all assets, even non-FDIC insured money, to a bridge bank so customers could be made whole. Maybe I'm being overly generous in my interpretation here, but when's the last time you heard of a private insurance corporation going above and beyond to make sure its customers ended up okay? Personal finance is personal. My grandparents weren't wrong for having multiple bank accounts. After all, I've written before about how it can be beneficial to shop around for the right kind of account for your purposes, even if that means you open multiple accounts at multiple banks. And they also weren't necessarily wrong for not trusting financial institutions, at least not beyond the amount they thought the FDIC insured. But a little bit more financial education could have benefited them enormously. Even without investing in the stock market, they would have been better off diversifying their assets and accounts. They could have put money in an HSA, bought additional property, invested in small businesses. They had 3 biological children and 3 foster children, all of whom would have benefited from a trust. And yes, staying invested in the stock market would have significantly improved their potential net worth over time. But they didn't do that. But again, they were both survivors of significant trauma. Nona left her country of birth to seek safety in a more stable country. And Poppy? He spent 70 years hiding his true racial identity for fear of racist violence. It gave them enormous peace of mind to know that their financial savings, at least, were insured, even if their understanding of that insurance was basic and flawed. Investing in the stock market was too stressful and volatile for my grandparents. They were justifiably risk-averse. This is what we mean when we talk about how personal finance is personal. But the lesson I want you all to take away from my family's story is this. Educate yourself. Knowledge of the FDIC and how it actually worked could have made my family's lives much easier and much, much richer. Listeners, if you enjoyed this episode, and please tell me you did because I worked very hard on it and read many dull government documents for it, you can join our Patreon at patreon.com/bitchesgetriches, or you can get more just like this at bitchesgetriches.com. We are an almost entirely donation-funded financial education media conglomerate. I don't know what conglomerate means. That's what we are. Anyway, join us at patreon.com/bitchesgetriches, or see our entire back catalog of articles, podcast episodes, and YouTube videos at bitchesgetriches.com. I especially want to thank our Patreon donors for funding this particular video. They are the wind beneath our wings. I say that all the time, but it's fucking true. I am an eagle, and I am soaring. on those wings that they support. Anyway, thank you so much to our Patreon donors, and thank you for watching. We'll see y'all next time. Bye-bye. Bitches out. Here we go. Today we're going to discuss, especially in the... You have eyeballs and ear holes, so especially in the aftermath of the Synenth Treasury bonds, especially in the aftermath... Some states in terror... Especially in the aftermath of the Synapse bankruptcy. That's like having a different insurance policy. Last one. Especially in the aftermath of the Synapse... I can't speak.